Most ICT traders know what market structure is, but almost all of them miss the one detail that actually tells you whether the price is going to continue or reverse. Once I learned this, structure went from confusing to obvious. It gave me a lot more confidence in my setups, and it showed me which side of the market I should be working on. And it genuinely improved both my profitability and my consistency. So in this video, I'm going to break down that structural detail. I'm going to go over what it is, how it works, and why it matters, and how it can transform the way you trade just like it did for me. So if that sounds good, be sure to stick around and watch this video all the way through to the end and pay attention, because you're not going to want to miss out on this. And if you're new here, this is day 7 of the 9 years of ICT series, where up until Christmas, I'm posting a topic on ICT concepts and sharing what I've learned and what actually works in my 9 years of trading them. Right, so market structure in its basic form allows us to identify trend within the market, which then communicates to us traders what we should expect price continue to do based on what it's done in the past. And everyone knows that in a bullish trend, we expect to see price structurally make higher highs and higher lows progressively, which then communicates to us traders that it's a bullish trend, and obviously vice versa. These are great foundational understanding of just being able to look at a chart and being able to identify the trend in the market. But to us traders, and to us day traders specifically, they don't really answer the question to us traders of why should price respect this current market structure, and where should price react from in order to continue the trend of the market structure. Because I'm sure many of you guys have experienced this. You see a market trending, you say, oh yeah, higher highs, higher lows, higher highs, higher lows, right? And then when now you go to enter the market structure is anticipating for price to continue producing, all of a sudden doesn't work, and you're left confused thinking, why did price not respect this structure? Why did price not respect this level? But one thing you don't realize is that not all market structures are created equally, and that's the main purpose of this video, guys. I want to give you guys the foundational understanding of how key structural lows and highs form, which are very important to how price behaves going forward. And just by being able to see these key levels in price, it helps communicate to us where price is leaning towards, especially if this structural formation here happens at key levels. And the structural formations are very easy to understand. For us to be able to deem a lower key low, we want to be able to see price have a higher low to the left of it and a higher low to the right of it after it's broken market structure to the upside. So in this example, price makes a low, and then price makes another lower low, and then from the lower low, this could be at the key level, price reacts from that key level, breaking the high that made this low, right? And then on the new low that forms, we want to see price fail to go lower than that low and then break structure going to the upside. When we see this pattern here around a key level, that's very indicative of what price is trying to do. Because if price is just going to be bearish, it's not going to go through all the trouble of trading into a key low and creating this structural shift just for it to then just immediately reverse and go lower. And obviously that's why we then look at this key structure here on an hourly chart. And the reason why we look at it on an hourly chart is because the hourly chart, it's not too high of a time frame for it to be out of range for our day trades, but it's not also too low in time frame where we have too much frequency, because then it's still going to be used intraday for reference points as price continues to progress towards its intended direction. So essentially what I'm really looking for is I want to see price create this key long-term low here, and then as price progressively creates market structure shifts to the upside, we want to see intermediate term lows form at fair value gaps, and those intermediate term lows should not be broken if price is bullish. That then becomes very key information to us as day traders, because all we need to do is literally just look back. Where's price currently trading at? Where did price react from most recently? Was there a key structural formation at that level that reacted from? And key levels come by way of higher time frame levels. It could have been a bullish order block open, a bullish fair value gap, a bullish breaker. As long as we can identify this structural formation around this key level, and we see that price is continuously creating new intermediate term lows that shouldn't be broken if we're bullish. So as price continues to trade higher, we now know that all we need to do, wait for that fair value gap to form, and then we know where price should react from based off the fact that we have an overall understanding of how price should behave because of this formation here, which then gives us a great deal of confidence as traders as we go into look for our day trades within the market, because now we know where these intermediate lows should form, and by knowing where it should form and confluencing that with time of day and having that degree of anticipation that, okay, it's the right time of day, and seeing price retrade those key levels at the right time of day, we're going to be so much more confident and so much more equipped in terms of understanding how to deal with these structures as they happen in price, because of the information that we're able to then draw from just by looking at, okay, where are we currently trading at in price? Have we met our high time frame opposing key level? No. Okay, where's price coming from? It's coming from a key level. Okay, at that key level, what did price do? It created a key long-term low. From that long-term low formation, has price been respecting the fair value gaps and making intermediate lows at those fair value gaps? Yes. So then just by us having that look back and being able to understand that information, we have a lot more confidence when it comes to framing bullish narratives for our day trading trades. And if price hasn't met an opposing high time frame PD array, you're going to have a high probability condition that price should continue to create these key lows at fair value gaps and continue to make this structure until it meets this high time frame key PD array. And then what happens if price doesn't respect these? Okay, then that's very telling of what price is doing, because if it's bullish, it shouldn't disrespect these intermediate lows. So once you see price then start disrespecting these intermediate lows, that's information to you as a trader. Okay, maybe the bullish structure is no longer in play for price. So then you wait for more information and then you start making adjustments based on what price is telling you. All right, so as we can see in this live chart example, we have a key level, an old daily low right here. And what happens? We have a long-term low here. Why is this a long-term low? Because look, to the left of it, there is a high low. So price goes low, creating this low, right? Breaks market structure here to the upside, comes back down, fails to go below this key low here, and then breaks market structure, creating a fair value gap. So a high low to the left, a high low to the right. This then becomes our long-term low. And the fact that price is making this structure at a key level after taking out an old daily low is very telling of what price might want to do. So then what happens? Price then fails to go lower than this low, breaks market structure, creating a fair value gap here, right? Price retrades into this fair value gap, creating a what? A intermediate term low. Moves away from it, right? Cool. Monday opens. Even look at that. New week opens and price still fails to even come anywhere near that intermediate term low. And that's good because that's price actually supporting our bullish idea based off of this formation and structure here. So then what happens? Price breaks structure to the upside, creating fair value gaps here, right? And I know you might be thinking, well, Gerald, why did you use this fair value gap instead of, you know, using these other fair value gaps? And the easiest answer for that is that if you take this low here to this high, that's the range as price broke structure to the upside, right? And this is the fair value gap that's below 50% of that range. Price again trades back into this fair value gap at what time? Look, if you go into your charts, you're going to see around 9:30, post 9:30, price does this and trades into this fair value gap here. So now you not only have an understanding of where price should form, and then by introducing an element of time, it gives you a framework of when it should happen, and when it happens at that time of day, that there is a high probability condition. Then you can then frame your trades around that narrative. And then today again, price is already near an old high here. This is an old daily high. It's going to be a low resistance liquidity run. You're not going to anticipate price to do a massive deep retracement. So what happens? Price then references into what? Another hourly fair value gap, trades into it, creates a key low. And we're actually going to zoom into a 15-minute time frame. You can see just how powerful this structural formation is. Price creates that key low and then moves away from it. Now if we go into the 5-minute time frame and the 15-minute time frame, we're actually going to see this key fair value gap here where we anticipate price to make an intermediate term low. You're going to see something special here. So what do we have here? We have that hourly fair value gap marked out. This is on a 5-minute time frame, right? Price traded into that key level during London Open, a time where we anticipate price to create a high low of the day, right? Price does create a market structure shift to the upside after trading into this key level here, where you're already expecting price to react and respect. It does give you a profitable trade, but then what happens? Price reverses, and look what happens. It still respects that key fair value gap. But now I want you to think about this. Now on an intraday level, think about what happened. Remember that structural formation I was telling you? Look what happens, yeah? Price runs the London low, takes out a key low. So now what do we have? A high low to the left of this low, right? And what happens? Look, price trades into that key hourly fair value gap again, trades higher, breaks market structure, and then post 9, price trades back into this range it made as it broke this market structure here, and then fails to go below this low. What does this become? On an intraday level, this frames to us and gives us the confidence that, okay, price shouldn't trade below this low. This then becomes our key low. So what happens? Price fails to trade below the low, creates a bullish market structure as it moves away from that low here. Look what happens here. Boom. And remember what I said, intermediate lows start to form at fair value gaps. This is a 5-minute chart. Do you see, understand the fractality of this, right? Price fails, creates a bullish market structure shift with a fair value gap, which then becomes an intermediate low. So as you're seeing this and you're already bullish, and you're seeing price do this, can you see how this then becomes key information? Because now you're saying, okay, by virtue of you seeing this market structure shift happen here and seeing this fair value gap here, you can have a great deal of confidence of you then actually using that fair value gap as an entry to get in line with the right direction, because you're using the narrative and the basis that price created a key intraday long-term key low at a key level where it was supposed to happen and show the structural formation of it. So this market structure shift here happening after price failing to take out this low just makes it that much more high probability. And then you see what happens. Price breaks market structure, retraces that fair value gap, and then explodes higher. And I hope you guys are having light bulb moments and you're taking notes, because the key is understanding the structural formation and then using the logic behind the structural formation of how price should behave. Now, if there was the right time of day, we would then anticipate price to then trade into this fair value gap here, because obviously from this low to this high, that's the new range, right? So then this now becomes an intermediate low intraday, right? So we wouldn't anticipate, if price is still bullish and price still wants to run high, we wouldn't anticipate price to want to trade below this low here. So we would anticipate price to then retrade into this fair value gap here, where an intermediate low should form, and then we could be looking for more longs at this level if time aligned with price, because you gotta remember, it's always time before price. So yeah, it's always about the logic and using the information and understanding the structural formations, which then gives us an expectation of what price should do, and then we can then use that in our trading to then frame our trades around based on the right narratives. So yeah, like, subscribe, and I'll see you guys in the next episode.